Hello there. Welcome to Federal Income Tax class, and we're going to be thinking today about common types of tax credits. There's several types. The first one I want to talk about is child and dependent care expenses. So a taxpayer is allowed to claim a credit for these, and the credit that the taxpayer can claim is somewhere between 20 and 35% of employment-related expenses. Now this is based on adjusted gross income. So no one gets totally phased out of these, but at adjusted gross income amounts of 0 and up, the taxpayer might be able to claim 35% of the employment-related expenses. As the AGI rises past $43,000, then the taxpayer can still deduct these child and dependent care expenses, but they can do it at a lower rate, 20% of the expenses. By employment-related expenses, we mean that this is not putting children in daycare so that the parent or parents can joyride or game or something like that. This is specifically a credit so that the taxpayer can go to work. Well, education credits are common, and for college students this is particularly true. There are two very common types of education credit. The first is American Opportunity Tax Credit, also called Hope Scholarship Credit, and the other is Lifetime Learning Credit. These are credits for the same type of items, but you can only take one or the other, and there's different rules for eligibility. So for the Hope Scholarship Credit and the Lifetime Learning Credit, the qualifying expenses would include tuition, fees, books, and supplies, but they do not include room, board, or activity fees. For the Hope Credit, the rules are a little bit different than they are for the Lifetime Learning Credit. First, the Hope Credit, 100% of the first $2,000 of those items I described on the previous page are a credit. And a credit, remember, means a dollar for dollar reduction of tax. Then, 25% of the next $2,000 spent, there's a dollar for dollar credit. So if you spend up to $4,000 for tuition, books, and so on, you can deduct you can get a credit for $2,000 plus 25% of the next $2,000. To be eligible to take the Hope tax credit, you have to your student, who does not have to be the person claiming the credit, it can be a dependent. For example, I've got a daughter in college. I'll be able to claim this stuff for her this year. The student has to at least carry a half-time normal load. That's often determined to be 12 hours. Possibly could be less. The student would have to be involved in a degree program. We're going to see that that's not true of Lifetime Learning Credit. So if you are taking a class to further your skills and it's not a degree program, there may be an opportunity to claim a credit, but it's not the Hope Credit. It has to be within the first 4 years. And so just to kind of clarify what that means, I've used these old standard college levels of freshman, sophomore, junior, or senior. So if you're not in one of those years, then you can't claim the Hope Credit. The Hope Credit phases out at $90,000 of what's called MAGI. And you're familiar in the course already with the term AGI. What the M is, it stands for modified. And here, some types of foreign source income would not be considered adjusted gross income, but would be added to this. So if your taxpayer or you don't have these foreign source types of income, you really just think of adjusted gross income. Also, because it comes up in Lifetime Learning Credit, I'm going to mention something about Hope that I didn't put in the slide. Under the Hope Credit, you're not eligible to take it if the student for which the credit would be granted was involved in a drug-related felony. So if they have a drug-related felony conviction against them, then you can't claim the Hope credit. And as near as I understand, that applies only to drug-related felonies, not to other types of felonies. We'll leave it to another time to decide or debate whether that's fair. Much, in my opinion, in the tax code is not fair. It's simply put on for political reasons, one reason or the other. And then sometimes it's offset against budgeting needs. And sometimes that produces some very strange results. But again, they're beyond the scope of this class. Well, the lifetime learning credit allows you to take 20% of $10,000 qualified tuition and related expenses. So if you go back and you look at the previous slide where I talked about what the qualified expenses were, it's the same. But here you can take 20% of a full $10,000. So Hope was a little better on dollar for dollar credits up to a certain amount, but lifetime learning credit, you can apply this 20% credit against a higher amount of expenses. So even if you were convicted of a drug felony, you are eligible for lifetime learning credit. Also, you don't have to be involved in a degree program. But notice the phase out. It begins at a much smaller dollar amount, $64,000, modified adjusted gross income. Earned income tax credit is one of the most popular credits, and we're not going to show you how to calculate that here. We're merely going to talk about the rules for eligibility and what the credit could look like in certain cases. I'd encourage you to practice in the pre-built problems, the LearnSmart, the Blackboard assessments that I give you, and so on. And make sure you read the book on this. But the earned income tax credit is on earned income. And that's the way to start. This is not per se a welfare payment. It is what's called a refundable credit, which means sometimes even if you don't have enough taxes that you've paid in, you might get all your tax money back and more. But it's based on earned income. It's based on actually doing work. So earned income includes wages, salaries, tips, and self-employment earnings. Well, whether you have qualifying children or do not have qualified children, you're eligible for an earned income tax credit. However, the government is much more concerned about people with qualifying children. So you'll notice that the eligibility is better and the amount of the credit is higher if indeed you do have qualifying children. So here are the examples of qualifying children: son, daughter, grandchildren, descendants, which as near as I can tell is like great-grandchildren, foster children, or an adopted child. And there are rules for what a foster child means for tax purposes and what an adopted child means for tax purposes. And I'd encourage you to look at the book or other tax sources where you can write me and consider that. Also, this qualifying child that we're talking about must be younger than 19 or 24. They're younger than 19 if they're independent, out working. They're younger than 24 if they're a full-time student. If they're 19, 20, 21, 22 and not a full-time student, they're still no longer qualifying children. The qualifying child cannot be involved in a joint return. And there's this little caveat. If the only reason they filed a joint return with their spouse is to claim a refund, they didn't owe any taxes, then they'd qualify. So they say don't file a joint return. They really mean as long as you didn't take advantage of the joint return filing status. And the qualifying child has to have a Social Security number. If the taxpayer doesn't have a qualifying child, then they must live in the U.S. more than 50% of the time. That means you don't so much calculate here how much in, how much out. Rather, the person has to have lived there longer than 183 days, 80, something like that, to be here more than out of the U.S. The age of the taxpayer must be older than 24. So we're not going to let people move out of their household, not go to college, and qualify for earned income tax credit. And they can't be younger than 65. So different things happen if you're older than 65, and you no longer can claim earned income tax credit. The person cannot be a dependent of anyone else, and they can't be a non-resident alien. Here are just some possible facts. Again, this is not designed to actually consider an earned income tax credit problem. It's just designed to give you some thoughts about how good the tax credit can be in certain cases. So the earned income credit percent could be 7.65% of earned income eligible for credit if there are no children. 34%, notice how that shoots up if there's one child. 40% if there's two children. 45% if there's three children. Now skip the maximum earned income tax credit on line 2. Go to line 3. Line 3 says for an earned income of $64.80, the maximum earned income tax credit is $496. You would get that multiplying 6480 times 0.0765. At an earned income of $97.20, somebody with one child would get a maximum earned income tax credit of $3,305. For somebody with two children, for earned income of $13,650, a person would receive a maximum earned income tax credit of $5,460, and for earned income of $13,650, also, somebody with three or more children could get a maximum earned income credit of $6,143. That person can actually make more money than the $6,480 up to the $13,650. This just means that even if they make more money, even if they make, in the case of 0 children, $7,000, they still can't take an earned income credit higher than $496. But notice that phase out begins at $8,110 for somebody with 0 children, or it could begin at $17,830 for somebody with 1, 2, or 3 children. These are taxpayers who would file single, married filing separate, or head of household type statuses. The phase out end, as good as it can be. So I've got the extremes here. As low as it can be for phase out, as high as it can be. But the phase out at the end is married filing joint rates. And as you can see, they go from $20,020, where you'd be totally phased out if you had no children, to $52,427 if you had 3 or more children. Again, I'd encourage you to practice earned income credit more other ways during the class. This is just designed to show you how earned income tax credit could look. There are other credits that we're not going to talk about much here, but let's keep in mind what they are. There's the foreign tax credit. This is designed so that if you pay tax in another country, you don't pay tax in the United States on that same amount. Let me make this incredibly simple. If U.S. tax law said you owed $6,000 and Danish tax law said you owed $5,000, you'd pay $5,000 to Denmark, you'd claim a credit for the $5,000 to the U.S., and you'd still pay the extra $1,000 to the U.S. So it doesn't completely wipe out tax if you pay a foreign government, but it wipes out the U.S. charging you tax that you already paid somewhere else. Child tax credit, there are several rules about eligibility for this, and it can be phased out, but the child tax credit can be up to $1,000 per child if the child's under 17 years old. Retirement savings, in some cases there's no tax on money saved for retirement because you get a credit where you reduce your tax by the amount you saved for retirement. And while the rules are somewhat complicated, in many cases, I would venture to say most, adoption credit is available for people who've spent money to adopt a child. Well, that gives you a good idea of the basic tax credits. Give me a call if you have any questions as you're working on the chapter. Take care.